Hey, this is Market Moves with Matt, and I'm just going to teach you about moving averages today. I put moving averages on anything that has a candlestick chart because I think it's a really good gauge of where you think price can go and how much longer you think price can trend. And if you think we're in a sideways trending market or a bull market or a bear market. So there's a lot of keys I watch to how the moving averages intertwine with each other and how they work together. So I use two types of moving averages. I'm going to shut this on the side and I'm going to show you. This is the SPY with a 50-day moving average and a 200-day moving average. So if you know anything about averages, is that prices or anything likes to revert to the mean if it has an average. And this can be seen with the SPY. So in the last couple months, especially during the tax cut, this huge run up during the tax cut proposal, and when it got put in place, a lot of buying was put in the market. And this was very far from the moving averages, the 200 and the 50. And when you get far from these averages, you always want to revert to the mean. So that what that means is that price is coming to both of the averages. And price sold off to the first average, and then it sold off to the 200. And it's a very clear signal when price reverts off the 200, and that is usually a support level. The 200 moving day average has this thing called the Dow theory, which says if it's under the average like it is here, you should sell, and when it's above the average like it's here, you should buy. And it's under here, it's over here. Right now we're doing this thing where prices are getting intertwined together. And this is pretty normal in markets, especially markets that have been in huge runs for a long time like ours has. And I always look for the averages to come back together. And when this sell-off happened, I was looking for these two averages to either touch or cross like they did. And that is one trading strategy I use. I use the averages as support or resistance, meaning they bounce off the average from a support level right here or a resistance level maybe right here in this red candle. So when the averages are trending up, as in their slopes are both upward, that is a sign we're in a bull market. So if they're both trending upwards, we're in a bull market. If they start crossing over a lot, that means we end up going to the sideways market, and we start trending in this price range that can be wide or tight for a while. And when they cross a lot, it just takes a while to get out of this price range. And I'm going to go to some other time frames to show you how the averages can also move together. This is the 1 minute chart, which is obviously pretty volatile compared to the 1 day chart. The averages can have a huge discrepancy pretty instantaneously from the open, and it takes a lot of catching up. So that 200 moving average is going to take a while to catch up on the 1 minute chart. And once this big gap between the averages forms, it takes a while for them to close it. And that just means that price usually doesn't go much lower, because the further and further these averages get, the longer that consolidation period needs to be. So prices usually drop, consolidate, and it's usually not a straight shot down because those averages can't get too far from each other. And if I go to this Bitcoin chart, Bitcoin is a prime example of how the averages like to stay together. So Bitcoin had these two averages come close together until the spot here where they crossed. And right when they crossed, that is like when all the momentum is pent up. And then once it's all pent up, it picks a direction. And it's sold off here, drag the average, the faster average down, drag the slower average down as well. But this gap formed. And now we're trying to close the gap between the averages because everything is mean reverting. Everything likes to go to the mean, which is the averages. And you can see this here in the 5-minute chart. We had a big sell-off on Friday, and we came up to the 50-minute average, and we came right through it, and we're trying to push those averages back together. Just as here, we were going on a bull run, and those averages were further apart, and now we're pushing them back together in this tight consolidation range. And once they're totally together, we drag them apart again. And if you can see how the averages are sloping, you can kind of gauge which direction we're going. But after a while, once you find these support levels, you can kind of see that the direction up or down might be over. And the support level kind of showed that here. And we kind of traded in a range. And then we dropped down on Friday. This is the 1 hour, kind of the same deal. One of the other things I want to show you was how clearly it can bounce off of these averages. I think it was in the 30. Yeah, check this out. So we're trending up, and then boom, we came back to the 50, right on top of it. What are the chances? And this just shows you how important they are. If we can drop right on top of these averages and bounce off, that shows you they must be in algorithms, they must be on people's watch lists, and they must be important for their computers. And once we got underneath the average consistently in this range, you saw that we dropped down to the second average. And when we dropped down to the second moving average, we did not sell off directly to it, but we tried to touch it. And what we're doing now, like I said, is we're trying to squeeze these together, get them closer together. Let's check out just some other charts, just so we can kind of figure out some other scenarios. This is the 1 day. The averages have been so far apart for many, many months. And then during the tax cut, they got insanely far compared to the previous months. And that sell-off allowed us to close these averages together. And we spent a lot of time between the 50 and the 200 day to the point where they almost touched here. And if they don't cross, and what you want to see is them getting very, very close together, like they do here, and then spreading apart again. So think about them like a magnet. And the way they're going to spread apart is if price makes a run up again. Just 2 more charts and we will be done. This is the weekly chart. The 50-day or the 50-week average has been touched a lot recently. 1, 2, 3. If we're testing it, that means that we're testing it for buyers. And if buyers come in and defend that level, that means that it's important. But if we keep testing it, and one day buyers are not going to come in, we're going to blast through this 50-week average and come to see if we can try to touch the 200-week average. And this is at 224 at the SPY, which would be a humongous drop. Maybe 40%, 35%. But it's not out of the realm of possibility because, like I said, these averages get close, and when they get far, they want to get close again.